All right, folks. Well, once again, thank you for joining us here on this beautiful Tuesday afternoon. Um, I'm super excited today with this session is have a guest speaker. And before I jump into it, I'd like to introduce you to Theresa Shutt, who's our Chief Investment Officer here at Harbourfront Wealth Management. She brings over 20 years of experience in private and public markets with demonstrated success in leading asset management teams. Prior to joining Harbourfront, she was the head of corporate debt for Fiera Capital, where she was responsible for the overall strategic direction of all Fiera's corporate private debt strategy. And prior to Fiera, she worked at Integrated Asset Management, where she was the chief investment officer there as well. Prior, she began her career working as an economist for the Conference Board of Canada and has held a variety of roles at large Canadian financial institutions, marketing both public and private securities. So super excited to introduce her. Theresa, welcome. Thank you for joining us today.
Pleasure to be here. Thanks for tuning in, everybody. Look forward to a deep dive on some of the current issues that we're facing today. It's an ever-changing world. Hard to keep up with it day to day. And yeah, look forward to the conversation.
So folks, as I asked last session, I said, hey, what are your thoughts about holding these on a more regular basis? And we had an overwhelming response that said, yeah, we'd love to be doing these more frequently, given the situation obviously going on globally, mostly down south. So today, our aim is to chat for anywhere between 25 to 40 minutes, depending on what kind of questions we get. It is a tighter and more lean presentation today. We do encourage you, if you have questions, there is a Q&A section or a Q&A button at the bottom of your screen if you're on a computer. You can click on that. You can enter in your questions. We will try and hold a question and answer period at the end, or I'll try and pose these questions as we walk through today's content. So here's the agenda. We're going to talk about the equity market and some of the jitters that we've seen over the last 4 weeks. We will spend a little bit of time on the most recent election with the Liberal minority. We'll also talk about the trade war and the potential for common sense to hopefully prevail. And then we'll spend a little bit of time on bond markets. This is something that, I think we're very fortunate with Theresa's comments on here. And then we'll talk a little bit about the private markets, how we're seeing it filter into not only retail portfolios here at Harbourfront, but also how they're being positioned with a lot of the big institutional money managers as a way to mitigate risk. So just briefly, I'm going to start. I know you're not here to hear me speak, so I'm only going to spend time on the first 2 to 3 slides. And obviously, we got some news out of Berkshire Hathaway this weekend with Warren Buffett at the ripe young age of 94, announced his retirement here on the horizon. And in our lifetime, he's probably one of the most accomplished investors. And I just thought it would be good to start with a quote, which I think resonates over the last 4 to 5 weeks is, we don't have to be smarter than the rest. We just have to be more disciplined than the rest. And that's going to lead me into my next couple of slides. Theresa, feel free to chime in before you get into your part. But I thought these were very telling signs. We've been writing commentaries over the last 4 to 6 weeks. We've been talking about, those that are disciplined generally have a better outcome than those that let emotion creep into their investment decisions. I came across this chart and thought it was quite powerful. The illustration of what it actually shows over the last 18 years, going back to the global financial crisis, with many of us on this call have been together through these periods. And it's an interesting illustration of what happens when we stick to a disciplined investment strategy versus perhaps being more conservative. And it also speaks to the reasons why we invest. So on this chart here, there's 3 lines. I won't get too detailed, but this first line here, this orange line, in the global financial crisis, had investors moved to cash, this is the type of return they would have had over the long run. Again, no volatility. We would have slept really well at night, but you can see we would barely have kept up with tax and inflation. The second one is if you would have actually invested in government bonds. So again, a little bit more fluctuation, but obviously we've been through periods of really low interest rate environments. You would have done better than just having it in cash, but again, you would have barely outpaced tax and inflation. And then the last one, this illustrates the markets if you were in kind of a balanced mix, the 60-40 mix. And these circles you see here, these various circles, these are all the various events that have happened since the Great Financial Crisis. And so we look at Lehman Brothers collapse. We can see, a global crisis both in Europe. We can see, COVID. We can see Russia-Ukraine war and so on. Well, despite all of these headwinds, a balanced portfolio would have gained over the long run, despite all the uncertainty. And that's what we're seeing right now with a lot of the trade uncertainty. Obviously, those that have stuck to a plan have benefited in the last 4 weeks versus ones that have actually jumped in and out of the market. Now, for those of you, and again, we only had a handful of clients that actually, raised cash. We benefited. The S&P 500 did something it hadn't done in 20 years, which is to post one of the longest streaks. It was a 9-day winning streak. And that just actually ended just on yesterday. And over those previous 9 days, the market gained 10%. Okay, so despite, consumer sentiment being near lows, despite, Trump having the lowest approval rating in any modern presidency term in the first 100 days, despite markets getting off to one of the worst starts with the president, the markets actually surged ahead over the last 9 periods. And if we go back to just the markets in general since Liberation Day, when he announced the tariffs on April 2nd, if we look full circle, markets are actually flat amongst those just over 1 month. And as a matter of fact, one of the commentaries I wrote about, I said, when we get really negative periods, which we did here when they were first announced, one of the things I said is that often some of the best days in history or the best days in the market, they're clustered together with some of the worst. And we experienced that when he came out and put a pause on tariffs. We saw one of the best days in the markets across all North American markets. They had substantial gains. Some of them were the best in history, if not the second best. So again, our approach of being disciplined, sticking to an investment plan has served everybody on this call and all of our families very well. So that's about all I'm going to chat about, give a little bit of a market update. I'm going to turn this over to Theresa. Theresa, feel free to chime in. And again, thank you once again for your comments.
Excellent. Yeah. So, just going back to that previous slide, certainly, April came in like a bear, but really ended like a bull. So, volatility was high. Investors endured, what I would call some fairly gut-punching sell-offs, which was, quickly followed by this incredible rally. And I think to Wes's point, the last month's performance is just another example of why staying invested during these bouts of heightened market volatility is a better strategy than trying to time the market, frankly. And we can see that in, previous periods such as this. But, as Wes alluded, one of the key events, obviously, aside from the tariffs, is it was the Canadian election. So just moving forward then to the next slide. So really, besides the tariff turnarounds and takebacks was the election outcome with the Liberals taking a minority. So ultimately, led by Prime Minister Mark Carney, the Liberals secured 169 of the 343 seats to beat the Conservative Party of Canada, which secured roughly 144 ridings. So really it was a two-party race. But what does this outcome mean for investors? Particularly with respect to a minority government, during a time when Canada really needs to show unity on the global stage with respect to dealing with Trump. And during a time when our elected officials need to make some serious decisions. Often the horse trading, as we know, that takes place with minority governments can lead to more diluted and ineffective policies. That said, Carney has been pretty clear that he won't be creating any coalitions, and he'll instead work for every Canadian, which is definitely reassuring. And based on what appears to be already a successful meeting with Daniel Smith, he may be able to bring the needed collaboration that we need across both parties as well as geographic regions, because some of Trump tariffs, the policy there can be very divisive, particularly when it comes to the West. So in terms of implications for financial markets, minority governments in Canada don't always lead to negative returns, as you can see here in this chart. So while there is, a lot of settling that needs to take place, 12 months after an election outcome, we do see returns tend to stabilize and actually outperform majority governments. And going forward, it appears, again, that Canada has this two-party system. Frankly, the NDP was decimated in the election. So the need to work with the conservatives and pursue more bipartisan goals is more important than ever. We saw Carney today, obviously, with Trump. We'll talk about that later, I think. But certainly he's putting the right foot forward. But more importantly, I think, while Carney and Trump are, in fact, meeting on, tariffs and discussing the trade agreements going forward, the most significant trade war currently underway is being waged between two economic giants, which is Canada and the US. And just moving to the next slide. There we go. Perfect. Yeah. So I think, while the US has certain advantages, obviously it does have a bigger economy than China, and it does exert more influence over the global financial system. I would argue the US is in fact more vulnerable than China in implementing this trade war today. The key factor favoring China is the fact that the US is levying tariffs on nearly all of its trading partners, whereas China is really only at odds with the US. So the overall trade damage really stands to be greater for the US than for China. And it's undeniable that China sells more products to the US than the US sells to China. So the interruption in any trade will do more direct damage to China. But that said, the size of China's production of key products completely surpasses US production of the same goods. So that means that China can simply find other markets for these products. So while China, for example, accounts for, as this chart demonstrates, roughly 20% of imports of electronics and computers into the US, these imports exceed what the US can produce domestically by 1.5 times. For apparel, that's roughly 3 times. So to the extent that China can sell to other markets, these products can't be easily replaced by US domestics. They don't have the supply chains, they don't have the manufacturing capabilities. So this implies significant hardship for the US, at least in the short term. In contrast, the US exports to China are highly substitutable. And these are commodities like agricultural products. These are relatively easy for China to find other suppliers of these commodities on the international market. So, really there is an imbalance here, although the US seems to think that they're going to come out ahead. Frankly, Chinese manufactured goods tend to be highly commoditized or highly specialized, such as solar panels, batteries, phones, LED lights, monitors, gaming consoles, and so forth. China also possesses trade leverage in the form of rare earths, critical minerals that are needed for the production of military equipment and other electronics in the US. They also own almost $1 trillion in US Treasury bonds. And $700 billion of mortgage-backed securities. So they could really pursue significant damage on the US. So they do have a fair amount of leverage. Obviously, the tariff rate on China right now is exceeding 200%. And Trump just confirmed that he has yet to speak to Chinese leadership. But I think there is some recognition of this imbalance. And there appears to be some talk from the White House about the prospect of some trade deal and some softening of this approach going forward. So I think, this is yet to be seen. As we know, Trump needs to negotiate bilateral agreements with over 80 countries. We're already a month into this 90-day pause. So there's a lot to be seen in terms of how successful these trade negotiations go. But I think the most significant one to watch is how they deal and interact with China, because that has the biggest implications worldwide. So moving from tariffs and back to financial markets, because really that's what impacts us directly as investors. Let's look at some recent performance for these selected asset classes. So year to date, it comes as no surprise that U.S. equities and the U.S. currency has experienced overall negative gains, while Brent crude is also negative. And that's largely due to the expectation for slowing global demand, which has reduced the demand for oil. But we have also seen, this flight to safe haven assets. So we've seen gold really outperform, as well as global corporate investment grade. So stronger security type instruments, backed by, government guarantees, have obviously realized some gains. And of course, as U.S. exceptionalism, as they call it, has somewhat diminished. We have seen stronger performance in equity markets for Europe and emerging markets. So really, there's been a bit of a kind of shift again, that flight to safety, some softer performance in equity markets. But we've seen this before. And I do think this is temporary, unlike, a true recession where there's a bubble and oversupply. I think what we're going to see is some, maybe a modest correction, and then, kind of a reversion to the status quo. As we saw in April, the rapid sell-off in market did cause the White House to blink. And this is a positive sign, as it really demonstrates that these giant, egregious tariffs are unlikely to be implemented. Key deterrent for this was the reaction of the bond market, which really, I think, caused, Trump to do the take back turnaround. So moving to treasuries, because I think this is important. The reciprocal tariff announcement, the Liberation Day announcement, as we call it, really set the U.S. Treasury market on a roller coaster ride. I think what happened was, the White House implemented the tariffs, expected the equity market to sell off, but at the same time expected that cash to flow into U.S. currencies as a kind of that flight to safety again. The opposite, in fact, happened. What we actually saw is bonds selling off, which meant yields went higher. And this has some significant negative implications for the U.S., particularly due to the size of their deficit. Now, what drove this sell-off of bonds when we really expected, the opposite to happen? And there were a couple things that happened. The first was the Fed declared quite kind of unilaterally that they would not cut rates. The Fed Reserve right now has high concerns about tariffs being inflationary. They don't want to, kind of tie their hands in the future to potentially needing to raise interest rates if inflation really reignites. And so there was no indication that they were going to cut rates. The other thing that happened was a lot of unwinding of hedge fund trades. So these players can move the market and influence the market quite significantly. With a lot of positions that they were taking, and with the equity market sell-off that occurred, they needed to really sell off U.S. Treasuries in large volumes, and that put downward pressure on bond prices and upward pressure on yields. And finally, we also saw, probably for the first time, is foreign selling of U.S. bonds. So some investors have grown increasingly uncomfortable with the U.S. market, given the policy uncertainty, declining trust in the administration, concerns about, Trump and executive overreach, as well as the common disregard for law that we're seeing. And so during this time, we actually saw a lot of prominent flows into Japanese government bonds, suggesting that a large number of institutional players like pension plans were selling treasuries and diversifying into other government assets. We also saw this with life insurance companies that hold bonds for duration. And that's something that, we're starting to see more and more. So, as investors diversify into other currencies and gold, what we've seen is the, kind of official holdings of U.S. Treasuries decline. And this has actually been a trend that's happening for some time. So already, Treasuries have been more than halved from 1/3 of the market a decade ago. And that's something that people don't talk about a lot. And, what we're seeing as well is that the U.S. has had increasing difficulty to get people to hold their debt. That debt continues to grow. And it has fundamentally reached, an unsustainable level. So interest payments now have reached 7 trillion on U.S. debt. And that's the highest historically it's ever gone. So I think, where Trump was hoping that people would plow into bonds, which would reduce interest rates, therefore forcing the Fed to cut, which would have reduced the cost of that debt, the opposite happened. And I think actually it was that dynamic that caused the U.S. government to blink and to pause the tariffs. More that than, frankly, the sell-off in equity markets. So, as a result, in the next slide, you can see, as there's increasing concerns about U.S. inflation, higher interest payments as a result, and this kind of growing debt, which would be further exacerbated, frankly, by the larger corporate tax rates that Trump is proposing. We've seen, the compensation that investors are demanding to hold those assets increase. So what that means is higher interest rates, or what we call the term premium. So frankly, the U.S. is positioning and frankly grandstanding as a bit of the superpower, but there are a lot of cracks in its economic fabric right now. And it's something that, the U.S. government has to start paying attention to. I think you've seen some calmer voices prevail in the U.S. administration, with Bisonte and some of the others having more influence on Trump. We're seeing him take a softer stance somewhat to some of these trade negotiations. We have yet to see, what that actually looks like. So I think there's a lot that needs to develop over the next few months or so. But I think there are some positive signs that we're not going to return to this world of, 46% tariffs, et cetera, on Asia and other places around the world. So in terms of what this means for the global outlook, and again, you need to make a lot of assumptions on what tariffs look like, because this will really be the driving force in terms of any forecast or estimation going forward. There's been a lot of forecasts now provided by the banks and a general consensus that tariffs will likely land around kind of 10 to 15% universally across countries. The tariffs on China may be roughly around 50%, which will have obviously a negative impact. Frankly, nobody wins in a trade war, but it has, I think, reduced conversations or diminished the expectation of recessions. Right now in Canada, I think we're talking about maybe a 40% chance of recession, maybe more of a soft landing. In the US, we can certainly expect a slowing economy. So, closer to, I think what we have here is under 2% growth. But certainly this could change depending on the outcome of these trade negotiations. But I think we're heading to kind of a more certain and stable environment, just based on some of the rhetoric that we're hearing globally. For Canada, we're expecting GDP growth closer to 1.2% this year, and maybe soft or maybe 0.6%, again, if tariffs are implemented across the board. If there is a successful negotiation of CUSMA, we could see even a better outcome. And I think what we're going to see is again, maybe sector-specific tariffs like we've seen on aluminum and steel. I think those will remain, maybe something persisting on energy. But I think even on the auto sector, we're going to see that lighten up a bit as there's more appreciation of how integrated the supply chains between Canada and US are. And frankly, I think in across the developing world, again, we'll see some softening, kind of growth rates closer to 2% or under, and we'll see some stronger performance out of Europe. Frankly, they have, probably struggled the most in terms of a region post-pandemic, and we're seeing some kind of stronger signs and some better tailwinds in that market. So I think, weigh in here, Wes, if you've got any kind of views. I've moved around from tariffs to financial markets. I think they're all kind of intertwined these days. It's hard to talk about one without talking about the other. But I think, I'm certainly feeling more optimistic than I did early April. That first week was a little bit disenchanting, to say the least. But I do think there are some tailwinds developing. And I think, as you said at the very beginning, at the outset, hopefully some common sense will prevail.
Yeah. And all great comments, Theresa. Thank you. And I think, we heard it today a little bit, and we'll maybe chat about this near the end. But even Trump's stance today, his comments were much softer than when they were 3-4 weeks ago when talking with Mark Carney. So it seems like his outlook has actually changed, not quite as divisive as what it was 3 to 4 weeks ago, which I think is cautious optimism on a go-forward basis. But I believe they still have the opportunity to make some decisions that will be beneficial over the mid to long run. But if they sit on their hands and they can't get these negotiations or trade negotiations started, perhaps things could deteriorate a little bit more before we see them turn the corner. But time will tell. It's very unpredictable.
Yeah, I would agree. And I think that the Canadian government is taking the right approach. I think at the outset, the reaction was kind of tit for tat. So, introduce reciprocal tariffs as they come in. But I think, working with Trump is really the only solution. While it is appealing to develop trade relationships with other regions such as Europe and Asia, those trading relationships are fairly entrenched. So it's a lot more challenging than we think it is to start trading with the Europe. US really is our most kind of important trading partner. So I think we're fairly confident that we can hopefully get something in place soon. And if not, Canada does have leverage. We are a major provider of critical minerals. Frankly, we are the US's largest source of crude, and that won't change. So we do have some levers that we can still employ, if need be.
I think this is a good, maybe this is a good segue here as we transition. Although things are a little bit more clear today than what they were 4 weeks ago, risk is still top of mind for a lot of folks. Whether it's our families or even when you're just talking to friends and family, all of them have an opinion about the potential risk on a go-forward basis. So why don't we unpack a little bit about maybe some thoughts about how we might be able to maybe mitigate some of that risk, or what we should be thinking about. Obviously, if things continue to move forward on a positive side, we don't want to miss out there, but we also need to be pragmatic in terms of how we manage risk. Would be interested to get some of your opinions on this next section here.
Yeah, absolutely. I think, it's been a volatile decade, frankly. With the pandemic, obviously, an event that nobody anticipated that had far-reaching implications, and still does, frankly, in certain, dislocations and supply chain issues. And then obviously, kind of the overreaction after, inflation came on and, all that pent-up cash was being, spent. The high interest rates that we dealt with that, kind of obviously upset the market as well. So it's been a time of a lot of volatility, frankly. And as well, there's certain traditional approaches to investing that just have not been able to, provide that resilience that you need in your portfolio. The 60-40 approach specifically, 60% equity, 40% bonds, that work during a time where there was that strong negative correlation between the two asset classes, did provide a bit of that buffer to some of this kind of this stormy weather that we've experienced. But more so today, those two assets, are increasingly moving in the same direction as we saw during that first week of April when, equity markets sold off and bond markets sold off at the same time. Obviously, gold can be attractive and there's other defensive sectors, but at the end of the day, more and more investors really need to start thinking about private asset classes to, provide that, that's more stable return, that lower correlation, and, that kind of better downside protection that's offered through privates. We've seen, obviously, pension plans adopt these quite readily. They've been in this space for 20 years, and it continues to grow. So maybe just to set the stage to talk a bit about privates, and I know we have a broad audience here, so some of you may be familiar, some of you may be less familiar, but I think there's some important market dynamics, that really I think have set the tone for the asset class and really provided the conditions for its popularity. So moving just maybe to the first slide, Wes. So this I think is an interesting slide in that, for many of us, we think of, asset classes and markets as the public markets. We look at the S&P 500, the Mag 7, some of the big names there, Apple, Microsoft, and we kind of think that that's the market. These are the businesses that exist. But frankly, if you look at companies with revenues over 100 million, the larger proportion of those companies are actually private companies. And those aren't represented in any index or exchange. These are businesses that aren't publicly traded, that have large, market positions. They're global players. They've got significant EBITDA, employers of tens of thousands of people. And they actually constitute the larger part of our economy, which I think, is surprising to many people. So they've become, increasingly, more larger users of capital, frankly, than public markets are. So what we've seen is the growth of that private market space to supply those private companies with capital. So as you can see there, like in North America, Europe, and Asia, in the bar chart on the left, again, that high percentage of companies that are private. And then we see in the line chart on the right, the kind of the diminishing size of public market companies. And that's because of, a couple things. To be a public company, it's very expensive. The regulation is very onerous. You're required to do a lot of reporting. And often your capital market solutions or how you raise capital is very commoditized. It's not very bespoke or customized. It doesn't always meet your needs. Where private companies, obviously have more control over their destiny, and now they have access to capital market solutions that are really more bespoke and tailored to the unique needs of their business. So just moving forward then to the next slide. So we've seen the growing adoption of private markets within our pension plans, OMERS, teachers, CPP. Looking back to 20 years ago, that wasn't always the case. In CPP, back in 2000, roughly 95% of their allocation was to government bonds. So they were just looking for steady, easy returns, not a lot of volatility. But as pension plans became somewhat underfunded, they needed to divert to other assets to earn those returns. And where they turned to was private markets. Starting with private equity, moving into private debt, real estate, and now into infrastructure. These asset classes comprise over 55% of all pension plan assets. Some of it that they're doing externally with managers, sometimes they're doing it directly, but it's become a growing component of their portfolio. And there's a number of reasons why they've done this. Obviously, there's enhanced returns that come with private markets. There's better diversification because you're accessing more companies, more sectors of the economy, and there's less volatility. And that's really attractive for these large players. And then today, now we're seeing access for retail investors. Traditionally, these asset classes were really only available to large institutional players, and now we're seeing them for retail. And we think that, frankly, 55% is probably not the right allocation to privates, but something maybe closer to, 5 to 30 to 50%, depending on the investor, their liquidity profile, and their return and risk objectives. So maybe turn to the next slide. So I think this chart is a very important one. Clearly what this does is it shows the risk return trade-off across asset classes for both public markets and private markets. So you can see, fixed income and equities here. Not surprising, fixed income have, investment grade or government bonds, earning, 2 to 4%, but lower in terms of risk measured by standard deviation. Equity markets traditionally 7 to 8%, but obviously experiencing higher volatility. Where we see private markets outperform is both on return and risk. So generally speaking, private equity, you can generate returns upwards of 10 to 12%, private credit 8 to 9%, and much lower volatility, as well as a higher Sharpe ratio. And this is something that isn't recent. Frankly, this chart captures data from 2008 to 2023. So this is capturing many economic cycles, downturns, COVID, the sell-off of 2022. So it's proven, itself as a very kind of stable, resilient asset class with a very compelling track record. So this is a slide that we show often when we're educating clients about the benefits of private markets. And what we're doing is we're looking at the traditional 60-40 and then carving out of that an allocation to private markets, and that being private credit, real estate, and private equity. And as you can see there, just that kind of basic allocation, pivot yields higher returns, roughly over 100 basis points. Lower volatility, almost 200 basis points lower, and an increase in the current yield. And again, this captures information from a long time period, 2016 to 2023. So this isn't kind of a new trend or getting on the bandwagon. Private markets, frankly, have been in the market for decades, and it's something that has continued to outperform. Obviously, these are illiquid. So this is a buy and hold strategy. You don't trade in and trade out of these, but they are ideal for, retail or high net worth investors that are looking for, the potential for that increased return, the lower, smoother return profile, and better downside protection. So really in today's market, private markets has definitely proven its worth. I have an umbrella here because I think, it's been a stormy period, at least in the markets. And it does provide protection, particularly when you experience the type of stress and volatility that we're seeing in equity and bond markets today. So just going and looking at asset class, I'm not going to get too granular here, but if you look at private debt, it generally outperforms public fixed income for many reasons. It has, security, it has tighter restrictions, it's customized, meaning that if there's a problem, you recover far more capital than you would in a public market bond. As well, because of that higher customization, you get that higher coupon or yield with private equity. Again, there's a lot of deal activity that we're seeing in the market. Private equity fuels that M&A activity. Private equity firms buy and control businesses, so they're able to create more value than you see with a public company. And again, because it's highly customized, you're getting that increased return. Private real estate, this is something that, again, we're all in private real estate. We all own a house or a cottage. So this is probably the most familiar to us. But when you have specialized managers that know how to, buy undervalued properties to make the enhancement, bring in better tenants, increase rent, the returns are significant, both in terms of capital appreciation and cash flow in the form of rent. Infrastructure is kind of a recent entrant to the private market space. This is something that is uncorrelated to traditional markets. It's based on projects that are fundamentally essential economic services, so very low correlation and strong, stable return characteristics. So, these types of investments, and there's, many different flavors, they are more complex, so you need the expertise, obviously, to allocate and to invest, but they're an essential component of a resilient portfolio, particularly today when I think, while I think there are positive, again, factors on the horizon, one thing we can expect is constant volatility. This one I think is a great slide. This focuses just in private equity, but when you look at periods, stressed periods over the past, 20 years or more, looking at the dot-com bubble burst, the GFC, Great Financial Crisis, the pandemic, and obviously the inflation shock that's most recent, you can see that outperformance with private markets vis-a-vis typical public equity markets, the S&P 500. So during the Great Financial Crisis, obviously we saw a decline in assets across the board. In the S&P dropping 21.2%, we only saw a 3.3% drop in private equity. And even most recently with the inflation shock, even though markets dropped more than 10%, we saw positive returns in private equity. And the reason for this outperformance are the factors that I mentioned earlier, which is, that illiquidity premium, the ability to customize that downside protection because of those control mechanisms that private investors have, and that larger opportunity set that provides greater diversification and, again, lower volatility to traditional markets. So I think this is, a great time maybe for Wes. You can, add a few comments here. I know, you're obviously highly experienced with privates, and frankly, we're instrumental to the development of, some of our products that we currently have on our platform. But yeah, I mean, your thoughts in terms of, how an investor should think about privates in today's market, and about how maybe to incorporate this asset class.
Yeah, thanks, Theresa. Yeah, you mentioned about the bond sell-off in April, spooking the U.S. to perhaps become a little bit softer on their trade stance. We actually saw this, previous to 4 weeks ago. We actually saw this in 2022. Yeah. We had the first bear market that we had really experienced, true bear market, notwithstanding COVID, and markets shaved double-digit percentages, and our fixed income market was down almost double-digit as well. And so generally, again, we tend to see in turbulent times, people kind of shift to more conservative or more stable quote unquote asset classes, which is generally fixed income. And I think that year it was somewhere down 10-12%, the fixed income pools here in Canada. So, having the ability to have multiple asset classes, in this alternative space, whether it's private real estate, private credit, or private equity, I think is a game changer in the retail space. And it's really unfortunate. We recognize that a lot of these big institutional players, whether it's endowment funds, pension plans, charitable foundations, they've figured this out, 10, 20 years ago, that they recognize more stability comes from these types of asset classes. But on the retail side, big institutions are not adopting. And I know when we, 6 years ago, 7 years ago, when we first entered the market, Harbourfront with multi-manager, multi-strategy type alternative investments, to be honest, I thought we might have had 3 to 4, maybe 5 years before we saw this shift in institutions that would also come to market. But it's been very slow. I can tell you, we still are a leader in that space. A lot of companies still haven't been able to figure it out. And even some of the biggest ones where people have their money, whether it's the big six kind of, financial institutions, the banks, they don't even allow it on their shelves. We get people that are coming from, banks like TD Bank that says they're just not willing to even look at it. So having this access, like I said, can be game changers in periods of volatility, which I think we've experienced with a lot of our families, which has been ideal.
Yeah. And I think, again, this idea of buy and hold and time in the market as opposed to market timing. And this is very much a private market investor. They're very much focused on fundamental value, creating value in these investments so that they can earn a higher return. They can be more patient. They have more time. They're less influenced by kind of investor-led sell-offs that sometimes can be highly emotional, as we've seen. And frankly, in the market today where things are trading really on tweets and market headlines because, people can't really just make sense of the world right now. I think we're still scratching our heads on why the U.S. wants to implement tariffs. I think that's still a question that remains unanswered. I mean, if it's for government revenue, sure, I guess that makes sense. But the economic pain that they're going to experience because of that, I think that doesn't necessarily increase tax revenues if people are poor. And I think this idea of bringing manufacturing back to the U.S., these are low-skilled jobs. They're low-paying. Other countries do it more effectively, as we know from the laws of comparative advantage. This will take decades. So, I think the thing that's really kind of stymieing, both managers, investors, and observers is just not kind of understanding what the end game is. And I think we're getting clearer. I think, again, the U.S. administration seems to be, I think, what's the word? I mean, becoming more reasonable and perhaps listening to, some experts and business leaders. And certainly, I think Canada was very successful in influencing state administrations. So hopefully, that type of outlook, continues. And then, but I do think tariffs are here to stay. I do think this is something that, will force Canada to adapt to. I think, there's lots we can do in terms of, working with the U.S. and trying to secure some wins. Hopefully that doesn't come at the cost of any of our natural resources, which I think, frankly, are, that really kind of create the standard of living that we have here in Canada. And I hope that there continues to be momentum to deal with some of the structural issues that Canada has today. Primarily the interprovincial trade barriers, some of the constraints to building some of these national projects for either energy or electricity. So hopefully we can continue on that path and get some of these, some of this infrastructure built, because I think that's what really makes Canada strong. It's not exporting goods to the U.S. It's the ability of this nation to create, strong products and to, really effectively extract our natural resources in a, obviously environmentally responsible way. So I'm hopeful that, this government will continue that conversation. I think we're less about elbows up today. I don't know what you think, Wes. Hopefully it's still a little bit of buy Canada. We've seen obviously less travel to the US. That will probably continue. But I'm kind of less of a buy Canada and let's build Canada. I think that's really important. We can't let the US and the tariffs steal all the headlines. There's a lot of work we need to do in Canada, really, particularly with our productivity. And there's a lot of important good investments that we could be making in this country. So I hope that continues to be on the agenda in our discussions. But I think the first thing we need to do is get past these negotiations with the US. That's been a major distraction for us and for this new government. So, hopefully once we get past that, we can implement some of the needed investments that we need to make within this country.
Yeah. Now, I do have a couple of questions that have come in, which is great. Just a handful, but we have one that's posed the question is, with all this trade uncertainty, what do you think the impact is here, both from the Bank of Canada and also the US Fed with in terms of interest rates and what direction they may or may not be going?
Yeah, so I think, frankly, we will be experiencing more interest rate cuts here in Canada. I think, probably at least 2 more to bring us back to 2.25 by year end. We have seen the labor market soften a bit. The unemployment rate has risen slightly. I mean, with the uncertainty that continues to prevail, it's very difficult for businesses to make hiring and investment decisions. So that means obviously delayed activity and capital investment. So I do think, that does mean like layoffs and less hiring. So certainly the Bank of Canada will need to step up and likely provide some monetary stimulus. I'm hopeful that the Liberal government, when it's considering or putting together a fiscal plan, does it responsibly. I know that there probably will be some subsidies to tariff impacted industries, but I hope it's done in a way that does not, increase the budget or create any disincentives going forward. So I think, there will be interest rate cuts obviously in Canada that will have negative implications for the dollar, for the Canadian dollar. So I think, we had a nice kind of bump up a little bit in April, which was good. I was actually in the US at that time, but I do think going forward, the CAD dollar will continue to depreciate. I think that's just sort of a fact. Now that does make Canada more competitive, clearly. So that, there are some positives to that. And in the US, I do think the Fed is having or holding a pretty hard stance on interest rate cuts. I don't think they want to use their powder yet, because I think there is some concern and fear that the tariffs will be inflationary, which means they will have to raise interest rates. So I think we're going to see them stand pat for now.
Yeah, and I think they've actually had stronger than expected job numbers the last 2 reports, if I memory serves me. So I think they're in a really tricky situation in comparison to the Bank of Canada. So and almost defiant in terms of cutting, which again I think is another reason why they have to get these trade deals done to help minimize some of the potential inflationary concerns. So and you hit on it earlier, the US and Canadian dollar. Obviously if we see cuts here in Canada, you feel the Canadian dollar will depreciate as well, which is good to know. Now, here's a question I had, and this is a little bit more subjective. I like the tone of this one, but it said, and you mentioned this earlier, there's a lot of foreign holders of US debt, of US treasuries. And a lot of them, a lot of the countries are the ones that are being impacted by these tariffs. So what are your thoughts? I mean, obviously we saw some volatility within the fixed income or bond markets.
Yeah.
How much of that do you think was perhaps some international influence of some of those big treasury holders that were perhaps moving that market a little bit?
Yeah, I think, from what I've heard anecdotally, roughly 10 to 15%. I think that's just going to be a quiet trend going forward. I think a lot of it was as the markets call it, the basis trade unwind. So these were a lot of hedge funds that were using leverage to implement a kind of an arbitrage. And I think when, the equity market sold off, They had to sell off a lot of bonds, and I think that was really what caused Trump to back off, because when that happens, the markets can experience somewhat of a liquidity squeeze, and we saw that with the GFC, and that's very serious. I mean, it could cause the market basically to jam. So I think that there's a we call it the bond vigilantes, and these are the bond traders that when they perceive governments being irresponsible or to spend spending too much or not taking care of their fiscal situation or balance sheet, they tend to punish by selling off bonds, which means higher interest rates and higher costs of servicing that debt. And we certainly saw that today, or sorry, in April. So I do think that, I think that was a kind of a warning. Again, I think the U.S. administration blinked. I think they're kind of better, they have better understanding of maybe the implications of taking any kind of more drastic measures. And I think that will keep them in check. That said, I do think that this term premium that I mentioned is real. I think, until the rest of the world has more confidence in the U.S. administration to follow a path that's perhaps more, predictable and reasonable, they will demand more compensation to hold that U.S. debt, which are the U.S. Treasuries. And I do think that, that coupon is going to be close for the U.S. Treasuries. The 10-year is probably going to be, I think it's going to be range bound between 4.3 and 5%. So I think that will have some implications. The equity markets, I think, Wes, you did a great job covering that. And I think, there's always that, the driver of AI and tech. I think that always provides upside to equity markets. I think, having DeepSeek come in the market, was a bit of a disruptor and did, rattle some of the players, but I think it's a good thing. And I think we're going to see, more development there, more progress, and that will fuel the equity market for sure, certainly in the U.S.
I got the last two questions or comments. We've got an overwhelming amount of them, but we had a fellow or an individual that said, are the private equity vehicles that we offer through Harbourfront US based or Canadian based? I think you mean currency. If so, they're available in both.
Yeah.
Private equity, private real estate, private credit, they're all available in either currency, which is a benefit. The last one I want to kind of sum or finish up on, we mentioned it earlier. We said, hey, we'll provide a couple of comments. We didn't quite touch on it. We kind of skirted around it a bit, but what are your thoughts on the meeting between Mr. Trump and Carney today? Your first thoughts. I know you haven't had a lot of time to digest it, but would be curious to hear what they are.
Yeah, I mean, I think it was positive overall. I mean, certainly, Trump's demeanor was not antagonistic, which we've seen sometimes with in the past, particularly with the former administration, Trudeau, and in particular, Chrystia Freeland, who he made very clear today at the press conference he did not like. I believe the quote was, "She's a bad, horrible person," which frankly is a bit personal. But this is how Trump talks. So it was an interesting conversation. I think Carney did a good job of standing his ground on the 51st state issue. He was very clear that Canada is not for sale. I don't think Trump. I think Trump did what Trump does, which was, not quite let the issue drop, and drop in a few kind of comments about, well, maybe let's see. But I think Carney's messaging was very clear. I think there's a lot of work to be done. I think what makes the most sense is probably to, move the CUSMA negotiations up to 2025. Currently the renegotiation date is 2026. I think it's very difficult for them to have a conversation about tariffs without, doing this at the same time. The commentary they both had was, it works, a few tweaks here and there, which is very positive because, as we know, Trump's approach to Canada is that, you know, any goods that are compliant with CUSMA or the USMCA will not be tariffed. So provided that, you know, this new agreement we can be compliant with, it works for Canada, that's very positive. So I think, you know, we have the right people at the table. I think the fact that the U.S. administration has brought new players and kind of a fresh outlook into the trade negotiations. So like Peter Navarro is no longer at the table. That's a good thing. You know, that his approach was very arbitrary and binary. So I think there are some, you know, better minds at the table to negotiate this. So it was an issue meeting. I mean, not much was really said. But I think it's a good start. I think it'll take some time to really figure out what the pain points are. But I think it's going to be, you know, some of the supply chain issues, protection, dairy, I think it could be energy, critical minerals. You know, my only, you know, if I could advise Carney on anything is I would say, you know, negotiate the tariffs on their own and not in conjunction with any security issues. You know, because I do think you know, Trump does have a bit of an ulterior motive. And I think he's used to the art of the deal where, you know, he wants to use maybe the tariff negotiations to get something else from Canada. So, you know, as long as we can keep those discussions separate, I think that's a good thing.
Excellent. Well, folks, I mentioned that we would try and keep this to roughly 45 minutes. We ran a little bit longer, but like I said, we had some great questions along the way here. So, Theresa, again, a humble thank you for joining us. For the folks that attended today, as usual, your comments were both timely, relevant, very much appreciated. So thank you so much for taking time out of your busy day to join us and give us your thoughts. So much appreciated.
Thank you, everyone.
Thank you. And everybody else, have a great day. Enjoy the beautiful weather we have slated for the next couple of days. If anybody has any questions, comments afterwards, you're more than welcome to reach out either by email or give us a call. We're happy to chat further. In the meantime, have a great day. We'll talk to everybody soon. Take care.